Hello and welcome to this Croner eCPD module on tax relief for purchase of goodwill and other customer-related intangibles, prepared by Paul Davis. Since 8th July 2015, it has not been possible to claim amortisation relief for goodwill or certain other customer-related intangible fixed assets. A most welcome development, therefore, in Finance Act 2019 is the return of a limited measure of amortisation relief for purchase of these assets. The new relief applies in a limited range of circumstances for purchases taking place on or after the 1st of April 2019. This module takes a close look at the new measure. It is important to understand at the outset that in referring to amortisation relief, we mean tax relief under the corporate intangible fixed asset rules that can be claimed during the lifetime of a company's ownership of an intangible fixed asset. This should be distinguished from tax relief, which can only be claimed when an asset is sold or otherwise disposed of. Relief on disposal or realisation, as it is called in the legislation, is already available under the intangible fixed asset rules and will continue to be available under the new measure, adjusted as one would expect for any amortisation relief already claimed. This module will help you identify the types of intangible fixed asset that are eligible for relief under the new rules. It will help you understand the basic 6.5% fixed rate amortisation deduction available under the rules and the circumstances in which it is partially restricted. It will also help you understand the circumstances in which the fixed rate amortisation deduction is wholly denied. Finally, it will give you an overview of the circumstances in which the basic rule is adapted to deal with related party situations. Taken together, these four elements represent the key learning objectives of this module. We will start on the next slide with a look at the types of intangible fixed assets that are eligible for the new fixed rate amortisation relief. The new measure can be found in CTA 2009, Part 8, Chapter 15A, and applies to accounting periods beginning on or after 1st of April 2019 and in relation to assets acquired on or after that date. Accounting periods straddling 1st of April 2019 are treated as separate accounting periods for this purpose. This slide identifies the various types of asset which qualify for the new relief. The legislation refers to them as relevant assets. Their meaning is based on the definition used in the former restriction on amortisation relief for goodwill and customer-related assets contained in CTA 2009, Section 816A, which has applied since 8th July 2015. This former restriction is repealed to make way for the new measure. The following types of asset are eligible for relief under the new rules. First, and very importantly, it applies to goodwill on the acquisition of a business. Second, it applies to an intangible fixed asset consisting of information relating to customers or potential customers of a business. Third, to an intangible fixed asset consisting of a relationship, whether contractual or otherwise, between a person carrying on a business and customers of that business. Fourth, to an unregistered trademark or other sign used in the course of a business, and finally, to any license or other right in respect of an asset within any of these categories. The general rule for relevant assets acquired or created on or after 1st April 2019 is that a company is treated as having made a fixed rate amortisation election under CTA 2010, Section 730. The effect of this deemed election is to write down the cost of the asset for tax purposes at a fixed annual rate of 6.5%. The normal 4% fixed rate of amortisation is overridden for these purposes. It is important to understand that the rules generally only apply to relevant assets acquired in relation to the acquisition of a business. We will come back to this requirement later. As you might expect, however, the general rule is either wholly denied or partially restricted in certain circumstances. The next few slides look at the restriction of the basic 6.5% fixed rate deduction by reference to the value of qualifying IP assets acquired with the business acquisition in question. Fixed rate amortisation relief under the general rule may be partially restricted by reference to the value of qualifying IP assets acquired with the same business in which the relevant asset in question is acquired. Note that a similar restriction applies in certain related party situations. Relief is restricted if the acquirer's expenditure on relevant assets acquired with the business is more than 6 times its expenditure on qualifying IP assets acquired with the business. The next slide explains what we mean by qualifying IP assets. We saw in the previous slide that fixed-rate amortisation relief may be partially restricted by reference to the value of qualifying IP assets also acquired with the acquisition of a business. This slide looks at what is meant by qualifying IP assets. You can see from the slide that there are 2 elements to the test, both of which must be satisfied. Firstly, to be a qualifying IP asset in relation to a company, an asset must be a patent right, a registered design, a copyright, a design right, a plant breeder's right, or right under the Plant Varieties Act 1997, Section 7. Note that the equivalent rights under non-UK law are also permitted. Alternatively, the asset may be a license or other right in relation to any of these rights. Secondly, the asset must not be to any extent an excluded asset within CTA 2009 Chapter 10, a pre-Finance Act 2002 asset within CTA 2009 Section 881, or the use of computer software. You should also note that, in all cases, the asset in question must also meet the wider definition of intangible fixed asset, as imposed by the IFA rules more generally. The allowable debit is calculated by multiplying the amount D by the amount RA. In this context, D stands for debit and RA stands for relevant amount. D is the amount of the debit that would, in the absence of this restriction, be allowable in an accounting period by way of amortisation at the 6.5% fixed rate. For this purpose, any calculation of the tax written down value of the relevant asset in question, in order to determine the value of D, proceeds by ignoring the effect of this restriction on previously allowable debits. The relevant amount, RA, has different meanings depending on the context in which the partial restriction of relief applies. Where the restriction applies by reason only of the qualifying IP restriction just described, the relevant amount is 6 times the ratio of expenditure on qualifying IP assets to expenditure on relevant assets. Where it applies by reason only of the related party acquisition restriction, the relevant amount is the ratio of relevant accounting value of third-party acquisitions to expenditure on the relevant asset. Finally, if the partial restriction of amortisation relief applies by virtue of both of those sections, the relevant amount is the amount found by multiplying each of the 2 ratios together. The restriction of the allowable amount is best described by way of an example. We will consider the acquisition of a business in which the value of expenditure on qualifying IP assets is £1,000 and the value of expenditure on relevant assets is £10,000. The ratio for calculating the allowable amortisation is therefore 0.6. This is calculated as 6 times the value of the qualifying IP assets acquired with the business divided by the value of relevant assets acquired with the business. Ignoring the effect of the restriction, the annual allowable amortisation under the new 6.5% fixed rate amortisation rule would be £650, being the value of the relevant assets acquired multiplied by 6.5%. To arrive at the actual allowable amount, we must multiply this by the allowable ratio of 0.6 to give an annual allowable amount of £390. The difference of £260 is not allowable by way of periodic amortisation relief, but may be allowable on a subsequent realisation of the relevant assets. The table shown in the slide calculates the tax written down values of the acquired relevant assets at the end of years 1 and 2. we will need these tax written down values to calculate the allowable debits arising on realisation. This is covered in the next few slides. The last two slides looked at the effect of the partial restriction of relief on amortisation relief claimed during the lifetime of a company's ownership of a relevant asset. To avoid claiming relief for the same amount twice, it's also necessary to adjust the relief available on realisation for amounts already claimed by way of amortisation relief. This slide therefore looks at the effect of the partial restriction on the allowable debits available on realisation. The allowable amount of relief on realisation is a trading debit, referred to as TD, equal to D1 times RA, and, in addition to this, a company can also claim a non-trading debit equal to D2 minus TD. For these purposes, D1 is the amount of the debit that would, in the absence of this restriction, be allowable on realisation. For this purposes, it is necessary to disregard the effect of this restriction on previously allowable debits when calculating the tax written down value of the relevant asset. RA is the relevant amount. We calculated this in the previous slide. Finally, D2 is the amount of the debit that would, in the absence of this restriction, be allowable on realisation, only this time we must not disregard the effect of the restriction on previously allowable debits when calculating the tax written down value of the relevant asset. Continuing our example from the previous slides, we calculate the allowable debits on realisation as shown here. Take some time to familiarise yourself with the calculations. The allowable trading debit on realisation is £2,220. The allowable non-trading debit on realisation is £2,000. If we add 2 years' worth of periodic amortisation of £390 per year to these two allowable amounts, the total allowable debit is £5,000. And this is exactly what we would expect, being the difference between the cost of the relevant assets of £10,000 less their disposal proceeds of £5,000. As we've already mentioned, an important point to understand about the new fixed rate relief is it only applies to assets acquired as part of the acquisition of a business. This, of course, will inevitably be the case for acquisitions of goodwill, but it does mean that, in the case of acquisitions of non-goodwill relevant assets, then the new relief is unavailable if the asset is not acquired in connection with the acquisition of a whole business, i.e. it cannot apply to acquisitions of stand-alone intangible assets. This is shown in point 1 of the current slide. Turning to other circumstances in which fixed-rate amortisation relief under the general rule is denied, the second case is where a company does in fact acquire the asset as part of the acquisition of a business, but does not acquire qualifying IP assets as part of that acquisition for continuing use in the business. Qualifying IP assets has a special meaning in this context, which we have already covered. Finally, the new measure is also wholly denied in the case of certain related party acquisitions from individuals or partnerships where the relevant asset was created by the individual or partnership, and also in relation to any assets subject to the former restriction on amortisation relief for acquisitions on or after 8th July 2015, i.e. the restriction contained in CTA 2009, Section 816A. In this latter case, such assets are henceforth known as PreFA 2019 assets. In the last slide, we looked at 4 circumstances in which fixed-rate amortisation relief is wholly denied. The fourth circumstance was where the relevant asset is a PreFA 2019 asset. This slide looks at the meaning of PreFA 2019 asset. Before delving into the detail, however, it's useful to understand that the broad intention of this rule is to exclude relevant assets held by a company between 29th of October 2018 and 1st of April 2019, and which are subject to the amortisation relief restriction imposed by CTA 2009 for assets acquired on or after 8th July 2015. The 29th October date is from when the 6.5% fixed amortisation relief measure was first announced, and the 1st April 2019 date is, of course, the commencement date of the new fixed rate amortisation measure. The legislation prescribes 4 cases in which a relevant asset is a pre-FA 2019 relevant asset. We only intend to briefly cover the first 2 in this module. Cases 3 and 4 are complex. They relate to avoidance situations and are not really necessary for present purposes. The first case applies if the company acquired or created the asset between 8th July 2015 and 31st March 2019 inclusive, and the asset was a chargeable intangible asset of the company at any time between 29th October 2018 and 31st March 2019. The second case is based on the rules in CTA 2009 Section 882 for pre-FA 2002 assets, and is intended to prevent the first case from being circumvented as a result of assets being transferred between related parties. One of the other circumstances where fixed-rate amortisation relief is wholly denied is in relation to certain related party acquisitions from an individual or partnership. The intention of this rule is to restrict amortisation relief for relevant assets acquired on or after 1st of April 2019 in a related party incorporation where the assets were generated internally by the transferor. This would apply primarily in relation to the incorporation of an unincorporated business. The denial of amortisation relief is based on the rule for goodwill, etc. acquired from a related party in former CTA 2009 Section 819D. It applies where 1. A company acquires a relevant asset on or after 1st of April 2019 directly or indirectly from an individual or firm to which we will now refer to as the transferor. 2. The related party condition is met. And 3. The third party acquisition condition is met. The related party condition is met if 1. The transferor is an individual who is a related party of the company at the time of the acquisition, or 2. The transferor is a partnership and any individual who is a member of the partnership is a related party of the company at that time. The next slide looks at what we mean by the third party acquisition condition. For goodwill, the third party acquisition condition is met if the transferor acquired all or part of a business in a third party acquisition in which, firstly, the transferor acquired goodwill, and secondly, the relevant asset is acquired by the company as part of an acquisition of all the relevant business. For other relevant assets, the third party acquisition condition is met if the transferor acquired the relevant asset in a third party acquisition and the relevant asset is acquired by the company as part of an acquisition of all the relevant business. The transferor acquires something in a third-party acquisition if a. The transferor is an individual who is not a related party of the company or connected person of the person from which the transferor acquires the item, or b. The transferor is a partnership for which no partner who is an individual is a related party of the company or a connected person of that person from which the transferor acquires the item. Finally, you should note that an acquisition is not a third-party acquisition if its main purpose or one of its main purposes is for any person to obtain a tax advantage. Nor is an acquisition a third-party acquisition if it occurs between 8th of July 2015 and 31st of March 2019 inclusive. The key things to remember from this module are, firstly, that you need to understand the exact nature of the intangible fixed assets for which the 6.5% fixed rate amortisation relief is available, mainly goodwill and certain other customer-related assets, collectively referred to as relevant assets. Secondly, you have learnt that the basic rule allows 6.5% fixed rate of amortisation relief, but we've also seen that the relief can be partially restricted where the value of the relevant assets acquired is more than 6 times the value of the qualifying IP assets acquired. The third key learning point is the 4 principal cases in which the 6.5% fixed rate of amortisation is wholly denied. This includes cases where a relevant asset is acquired, but not as part of the acquisition of a business, and also cases where a business acquisition does take place, but does not involve the acquisition of any qualifying IP assets for continuing use in the business. Finally, we looked at a related party situation where relief is also wholly denied. This rule is designed to ensure that amortisation relief is not available in relation to the incorporation of an unincorporated business by individuals or partnerships. I trust you found this module informative. Please exit this activity and click Launch Quiz to complete the quiz. Once you've completed the quiz, you'll be able to print out your personal certificate. The module homepage also contains a link to the notes that accompany this module and to further resources available to you from Croner I, including the Finance Act 2019. Goodbye, and thank you for using Croner I eCPD.
For further information and to view the full range of Croner I eCPD modules, visit our website at cronerI.co.uk.